how do comprehensive credit reporting, or CCR, and open banking impact a client's approval chances?
So yeah, like the open banking, which was probably taken on board the last 5 years by most banks.
Yeah.
Like it has become the norm to have open banking and comprehensive credit reporting. That impacts clients because the bank you're applying to has got an up-to-date view of your credit report. So if you had missed a payment in the last month, if you had applied for any other finance solutions or tried to get a personal loan or a car loan or a credit card, it's pretty much on your credit report within 30 days of that inquiry. Welcome back to the Broker's Lounge, and as usual, we always try to discuss any new financial topics relating to the mortgage space or housing space. And as usual, I'm joined by my co-host Carlo. Hello, mate. How are you?
I'm good. How are you?
Good, man. How you doing? All right?
Yeah, doing very well. Yes.
Sun's starting to shine.
It's blue sky. It's sun. The sun is shining. Birds are chirping.
Happy Father's Day.
Thank you. You too.
We just came out of Father's Day weekend, so happy Father's Day to all the fathers listening out there. And in today's episode, we're going to be answering questions that we have received or we've come across over the last few months. So we just put all those together and thought it's worth going over them and just answering to the best ability we can.
Yeah, no, looking forward to it.
Before starting anything exciting going on?
With me personally or at work? Personally, I'm going on a week's leave soon, which I'm looking forward to that. So heading up to Sydney and then driving back down along the coast, back down to Melbourne. So
you don't do enough driving during your weekdays, so
not compared to you. No, I'm happy to keep driving. So, but no, definitely looking forward to it. It'll be a good chance just to, although it's only 1 week off, it's just a nice chance to recharge the batteries a little bit as we head into the home straight towards Christmas and the end of the year. So definitely looking forward to that. So
enjoy it, man.
And yourself, anything exciting in your world?
Oh, no, I just came back from a long holiday, so
Still in holiday mode?
no.
Back to reality.
From day one, pretty much. So yeah, like you said, we've got pretty much less than 4 months at the end of the year. So heads down and just try and finish the year strong.
It's going to be a manic end.
Yeah, it's looks like it's getting busier. So I think we're going to be really busy by the end of the year. We'll see how we go.
Yeah.
Anyway, we'll jump into it. So first question we've got, how do lenders treat different types of income, like bonuses over time or foreign currency, when assessing borrowing capacity?
Do you want me to answer that one there?
Go for it, man.
Sure. Yeah, look, there's obviously a couple of different components within that. So if I tackle them one by one, bonuses can vary, and a lot of these things will vary from lender to lender, obviously. But bonuses is one that does vary a fair amount within the different lenders. Some will take the average, will expect at least minimum 2 years worth of bonuses. They may average it out. They may take the lower of the two. What we are seeing increasingly now, which is a great thing, is being able to rest on the most recent year's bonus income as well, and at 100% of that as well. Having said that, there are some lenders who will also shade that level of bonus as well. So maybe by 20% or thereabouts. So, but the good thing is, it's become, because it's so more common nowadays that people have decent bonuses. Like you see some of the bonuses of some people where they can be, you look at CEOs, they can be up to 100% of their base salary, but it's even just normal workers as well. It can make up a fair chunk of their total remuneration. So it's good that we can take that into consideration. Overtime's a good one as well. There's more and more lenders out there that are accepting more and more roles where it's part of the norm that they do earn overtime.
Yep.
Which is great because, if we were to just take the base wages of some of these employees, you could look at essential workers. A typical nurse will probably earn just as much in overtime as they would as in their base salary. So to be able to take that into consideration and be able to annualize that, so we can take, what's the current year to date and annualize that out to see where it's going to track towards. So that's good from that point of view.
Absolutely. Perfect, man.
Yeah.
Perfect.
And foreign currency is one I think we spoke about. Did we do a podcast on that?
Yeah.
So that's typically an interesting one because it all depends on which country they're earning foreign income in. But the main thing is that it is always typically shaded by 20, 30%, and obviously converted into Australian dollars as well. So, which can, it can discount it quite a bit by the time you discount it, convert it, and then tax it as well. There's not a lot, but typically we're dealing with people who are on fairly decent incomes as well. So, but the main thing that obviously come out of that is that every lender is different. They all have their different policies as such. So it's always best to run it past us, and we'll provide guidance from that point of view.
Perfect.
All right. So next question. I like this because it's probably something that's a little bit more unknown to people out there, but how do comprehensive credit reporting, or CCR, and open banking impact a client's approval chances?
So yeah, like the open banking, which was probably taken on board in the last 5 years by most banks.
Yeah.
Like it has become the norm to have open banking and comprehensive credit reporting. And that impacts clients because the bank you're applying to has got an up-to-date view of your credit report. So if you had missed a payment in the last month, if you had applied for any other finance solutions or tried to get a personal loan or a car loan or a credit card, it's pretty much on your credit report within 30 days of that inquiry.
Yeah.
So that's why it's really important these days not to, if you're applying or planning on doing something, make sure your credit report stays clean and you don't default on any existing debts, or you don't apply for any sneaky credit cards here and there, because you can't hide anything really these days. So it can really impact the outcome of what you're trying to achieve. So just be very mindful of that. And yeah, it affects your approval chances basically. If you had defaulted on your existing debts, that's going to affect your credit report straight away, and it's going to show on your credit report.
Yeah, it's in the past people was like, oh, so long as I don't default, I'll be okay. But open banking is, as it says, it is open. It's open for everyone to view within the banking sector, so they can see a lot more than what they used to be able to. So yeah, people really need to get their affairs in order if they're looking to apply for a loan. So.
Yeah, 100%.
Good stuff.
Good. Next one. So why does someone with the same income and deposit get a much higher borrowing limit with one lender than the other? So basically, we see a lot of people get different outcomes with different banks. So why is that?
There's a whole different range of reasons, to be honest. So it comes down to the fact that they will assess things differently across multiple different factors. So whether it be what income they take in consideration, to bonuses, to overtime, to how they assess other debts as well, all that sort of things, they will take everything into consideration. So
the buffer, and
correct. Yeah.
So certain lenders use a higher buffer on existing debts.
Yep.
Other lenders use lower buffers.
Yep. And
that obviously determines the outcome and how much you can borrow. And that's why if your bank, like if you go straight to your bank and they say, oh, you can't borrow this much, we can potentially go somewhere else and you can borrow more, because that bank is more lenient in servicing, and you can get yourself a favorable outcome.
Yep.
Good one. Next one.
How does a client's existing credit card limit, even if unused, impact their borrowing power?
Yeah, this probably is one of the most common things we talk about every day. I see a lot of people are more a bit aware about it these days, but there's still a lot of people unaware of it. So if you've got any credit cards, regardless if you use the credit card, if you've got zero owing on it, the bank will still expense the limit of that credit card. And that is due to the reason where banks see the credit cards as accessible funds, which you can use at any time. You don't need approval. So it's pretty much like a loan just waiting for you to withdraw on it. So if you've got any credit card, the bank will always expense the limit of that. It's usually they use 3.8% of the actual limit as your repayments. So if you've got like a $20,000, $30,000 limit on your credit card, that can potentially affect your borrowing by I don't know, about 100K. So it plays a huge factor in assessing. And if your servicing is tight, then having credit cards is not really recommended. You can either reduce the limit or close them if you don't use them. So yeah, it's very important to understand how credit cards affect your borrowing.
Yeah, it's one of those things that we cop a lot in that. Is like people go to us, yeah, I've got this credit card, but I don't owe anything on it. I don't really use it that much. So they don't even, sometimes they even forget to declare it.
Yeah.
It's like, no, we actually need to know this because it will be taken into consideration. So,
all right, on to the next one. How should a borrower think about fixing part of the loan versus keeping a portion variable? And I guess this is relevant in today's market because interest rates are dropping and there's some decent fixed rates. So some people are contemplating the idea of fixing. So
yeah, and you're right. And I think we probably wouldn't be, we'd have a different answer for this 12, 24 months ago where rates were quite high, and really the only thing we could see is eventually rates coming down from a variable rate point of view. But where we are now at the moment is that fixed rates are, as you say, quite attractive. They're below 5%. And the talk of further interest rate cuts is starting to diminish a little bit as well. So if you look at where the market's saying at the moment, they're only talking about one maybe this year and then maybe one early next year as well. So if you got two more rate cuts of 0.25% each, so it's 0.5, and you can get a fixed rate, close to 0.75% lower than the current variable rate, then it's can be worthwhile looking into to reduce your overall cost. Obviously, the first thing you need to be looking at is making sure that you understand the risks that go with fixing your loan. You are locked into a contract with the bank. It does provide less flexibility. So you're really going to understand what your longer term plans are as well. So if you're going to be fixing a loan for 2 years, you always need to be sit back and go, okay, nothing's going to change for me in the next 2 years. I'm not going to sell the property. I'm not going to look to refinance or anything like that. Because what you can do then is say, okay, I'll take advantage of the lower rate now. And even if rates do come down over those next couple of rate cuts or whatever it might be, you're still going to be probably ahead of the game. Where the issue will be is if the RBA does continue to keep cutting rates 2, 3, 4 times, whatever it might be, then you might fall behind the 8 ball. But it's definitely worthwhile considering it. Worthwhile considering splitting loans as well. So a lot of people still think that they have to fix the entire loan amount. No, you don't. Just you can say, I might fix it 50-50 or 75% fixed, 25% variable, or the other way around, whatever it might be. There is no right or wrong answer. It's a matter of understanding that if you're going to be potentially wanting to pay down more of your loan, work out how much more you can possibly repay and make sure you've got enough on the variable rate component, because that's the one that you can repay as much as you want, as often as you want, without any penalty. Fixed rate loans, you typically can pay up to about $10,000 per annum over and above your normal repayments without any penalty. Anything more than that, then yes, the banks will start to issue penalties against you. So just be careful about what your future plans are and just making sure that whatever you do with fixed rate loans, it applies accordingly. So perfect. All right, next one. What's the impact of 𝗵CI's serviceability buffer on refinancing options? Because I know people are wanting this to change.
Yeah. Well, there's good and bad impact on it, I guess. From a risk to the economy impact, I think it's healthy and it's good because it protects people if rates go up, like what happened in the last 3-4 years. Because the banks had already factored a buffer of 3%, then even though people's cash flow is stretched and they feel the pressure, but they can still manage to keep on with the repayments, which what we've seen in the last 3-4 years. It was very high interest rate market, but defaults weren't as much as people expected them to be. So I think from that side of things, it's pretty healthy. Now, from a servicing buffer, it can trap people in their home loans. So if you had taken a mortgage when rates were lower, and then with the buffer on top, you can just service that debt. Let's say you borrowed $600,000 and your servicing allowed you to borrow, let's say $650,000. And then rates have gone up. Now you can't service 650 anymore. You can't service 600, you can't service 550, and you can't service 500. So you're pretty much trapped in that mortgage. That's what they call the mortgage trap, where you can't refinance to better solutions, you can't service to lower rates, you can't service if you want to change it into interest only, and you're pretty much trapped in it. Now, certain lenders have introduced certain products which allows you to refinance on a 1% buffer if you tick the criteria, which helped a lot of people, but for the majority of people, they were trapped because of that buffer. So that's why when you borrow money, make sure you're thinking long term and you can afford if circumstances change in terms of rates or your personal circumstances change. So yeah, risk is very important to be.
Yeah, I must admit, I was always one that was very critical of the buffer in the early days. It's like, come on, man, like it's a bit too much.
Free money.
Yeah, but geez, I've changed my tune well and truly now because we've seen why it's there.
Yeah.
And I think it's good financial practice to be in that position where you know that rates do go up by 3%, you're still going to be able to afford it. So long as you are, declaring the right level of living expenses and all that side of things, and not just declaring enough to get a loan over the line. That's the main thing. So because then you can at least sleep comfortably at night time knowing that if things turn to poo again, it'll be okay. So
yeah. And if no one comes knocking on your door, that's it. Yeah, in Melbourne.
Exactly right.
All right, next one. How often should clients review their home loan and what triggers should they look for? That's a good one.
Yeah, I like this one here because people, it's amazing how, we had a client not that long ago said she hadn't reviewed her loan or had been meaning to review a loan for about 5 or 6 years. Actually, we've had a couple of clients recently who've been exactly, and it's like they are so far behind the eight ball now with where their interest rates are at because they haven't taken the time to do anything about it. So we typically say to people, you should be reviewing it, and we actually help out our existing clients all the time with this, at least every 12 to 24 months. 12 months is always a good one, sometimes even earlier, but at the absolute minimum, I think 12 months just to see and test the market, see where things, you don't have to go through with a full-on application, but at least speak to a mortgage broker and see where your current loan is at, test it against the market. If it's still in line with where the market is, approach your existing lender, see if they can cut the rates even more for you. So yeah, I would say every 12 to 24 months. In terms of triggers, obviously, if they've got a fixed rate, and we're talking about fixed rates, if that's expiring, that's obviously a perfect opportunity to review your total position. Changes in income or expenses, that's probably more so if you're looking to, I guess, do a refinance as such, where you might want to borrow a little bit more because your income's gone up, or your expenses have come down dramatically, whatever it might be. I think the big one is if your financial goals have changed, your financial circumstances where you're looking to do something, whether it be upgrading home, renovating, or even looking to invest, perfect time to look at not just that immediate need. You may get a loan to do the renovations, but that's the perfect opportunity to look at your loans in total and go, right, am I still with the best lender, with the best product, with the best pricing, yes or no, and go from there. So
perfect.
All right. This is a good one for investors. What role does cross-collateralisation play in investment lending, and why should borrowers be careful?
Yeah, look, I guess that's not just for investors, that's for everyone, because you can pretty much cross-collateralise any property there. So it's very important to understand the risk, but cross-collateralisation is basically when you bring more than one property together, you secure them against each other, against one line or multiple loans. So you've got a pool of securities joined together. And the risk that this brings is the impact that if one of those properties loses or drops in value or something happens, it can affect the other properties, and because they're pretty much tied together. So the reason people do that in the first place is to borrow the amount needed without paying lender's mortgage insurance. So they tie in multiple securities, then you've got a much higher value, and then you can lend against those properties. But yeah, this can be risky. First of all, it's messy. Can be messy because you've got multiple securities and you need to ensure all these securities are remaining or growing up in value. Otherwise, they impact you're borrowing. So you can get stuck in terms of if you want to refinance or do anything else. And it can affect the other properties if one of those properties is losing so much value for whatever reason that might be. So we always recommend releasing equity off a certain property and using that equity to buy another property. So you're not tying these properties together. So if you need to sell, if you need to refinance, if you need to do anything on one of the properties, you don't need to move everything across. So that would be my answer.
No, very good.
Yeah.
Very well answered, mate. Very well answered.
Thank you. All right. What are the implications of interest only versus principal and interest repayments for investors?
Yeah, I like this one. I guess interest only repayments for investors is one that I know a lot of accountants favour, purely because you get to maximise your tax deductions because you're not actually paying off any principal. So frees up cash flow. Your repayments aren't as much as a principal and interest repayment. You maximise your tax deductions in the short term as well. But on the flip side of that, can actually reduce your borrowing power as well. Reason being is that if you take out, say, a 5-year interest-only loan, when it over, say, a maximum term of 30 years, the lender will actually calculate your repayments on a principal and interest basis over the remaining P9 term. So if you've got 5 years interest-only, 30-year loan term, they'll actually calculate the repayments on principal and interest over that remaining 25 years as well. So it's not just calculating on the interest-only payment because, yes, that's what clients look for in terms of cash flow. When it comes to serviceability, they need to keep that in mind as well. So, obviously, with regards to principal and interest repayments, one of the benefits is obviously you build equity right from the start. So if you're looking to build a good property portfolio over time and your cash flow allows for it, paying principal and interest, you're building equity from day one. Assuming that the property continues to go up in value as well, but essentially, if it's for investment, you're typically looking at the property with longer term capital growth as well. Downside to that is obviously the repayments are going to be higher because it's building in both principal and interest, so cash flow will be a little bit tighter as well. So good and bad on both sides of the coin. So, but well worth looking into. Okay, how does self-employed income get assessed differently compared to PAYG or salaried income?
Yeah, look, I think in principle, they're not much different. It comes down to requirements from the lender. So if and there's different types of self-employed. You can be a sole trader, you can be under a company, you can be operating under a company with a trust. So there's a few different structures on how you operate as a sole trader or as, self-employed. So if you are self-employed, usually the lenders want to see your tax returns, personal tax returns, company trust tax returns. They want to see your notice of assessment. And usually they want to see 2 years of trading and 2 years of tax returns and notice of assessments. And then they use the average of the two. But there's a lot of lenders that are using 1 year tax return. So you can rely on your most recent tax return. And there's even few lenders that do not want to see the notice of assessment. They can do like with an accountant's letter confirming that these figures are final and will be lodged in due time. So I guess the biggest factor for being self-employed is the flexibility in terms of being able to use the income that you've earned last year. So the lender does not have visibility over how you're doing this financial year. So this can be good and bad depending. So if you're done really well last year and you're not doing great this year, you can still borrow based on last year's income, but you have to be careful to be able to service the debt moving forward. Also that you can do add backs as self-employed. You can add back depreciation, you can add back interest paid, you can add back a few other items, but then you might have to service if you've got any debts in the business that you need to declare. And also at the same time, if you don't use any add backs, you don't need to service any debts which are in the business name or in your personal name. So it's got some good advantages in terms of like if you're employed, if you're PYG, any debt is under your personal name. You have to use your current income based on year-to-date figures, based on most recent income. So if your income has gone down or has changed, then you have no other option. While with being self-employed, you've got more options. Also, obviously, you've got the low doc option. As self-employed, you can go off accountant's declaration as long as we can provide BAS statements just to show the business is trading and reaching the same level it reached previously. So yeah, obviously, that's a huge topic. We can talk about that on a separate probably podcast just for that question. But in a nutshell, yeah, that's the difference, main difference. All right. What's the income of rising debt to income ratios on lending approvals, or as we know it as DTI?
Yeah, DTI is one that probably hasn't surfaced a lot for some time now, purely because borrowing capacities have been impacted a lot more because of the higher interest rates. But as the interest rates are starting to come down now, people are able to borrow a lot more, which means debt levels are definitely increasing. And lenders typically will have a cap on on the DTI, or the debt to income ratio. So some of them will be 6 or 7. I think some even go up to 8, very rarely. But you need to be mindful of that, because if it goes above that, then lenders can say, well, we're not actually going to allow you to go that high. Investors quite often get caught in that trap because they're leveraging heavily. So they continue to borrow because they're creating equity. But they've got to be mindful that, that the income's got to keep in pace with that as well. Otherwise, that DTI ratio becomes a lot higher. So they need to manage that. It may be that they manage it across different lenders as well.
Yep.
But yeah, most lenders will look at what the total debt looks like compared to the total income as well. So, great if you're an investor and you've got good cash flow yourself. But you just need to be mindful of that. And like I said, we haven't seen a lot of it recently, purely because rates have been a lot higher. But I think we'll see more and more of it, and be interested to see whether lenders will change their policies in line with that. I don't think they will personally, purely because they get a little bit nervous when clients start to really ramp up their level of lending.
Yeah.
And it gets to you're talking about, say someone's earning $100,000 a year or even more than that, maybe $200,000 a year, and you've got a debt to income ratio of 8, that's a fair amount of debt they've got to be able to service. So if things turn the opposite way quickly, then yeah, we could find people in mortgage stress. So
yeah, I think that should do for today's session. There's still a lot more questions. Maybe we'll do other sessions later on.
Yeah, we've definitely got a lot more to answer. And like you said, I think the one on self-employed income would be a really good one, because I think there'll be a lot of self-employed business owners out there who probably don't quite understand. They may understand more on the commercial lending side of things, but when it comes to their personal income, their personal debt, how does it actually affect that? So I think it'll be a really good one that we do down the track. But it definitely highlights that there's lots of different quirks and strategic opportunities within the mortgage lending space, and you need to make sure you're getting the right type of advice. But obviously, if there's more questions that you want answered as well, please feel free to leave us some feedback. We'd love you to subscribe to our podcast going forward as well. Leave us a review, preferably a 5-star review as well. But I think until next time, we'll call it a day.
Yeah, absolutely. Thank you very much.
Take care, everyone. Bye-bye. Bye.
Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Head to the show notes if you want to book a free call to discuss your personal situation.